Why would you buy a 30-year bond at 475? Think about it. When you could buy, a 2-year bond at 385. They're going to keep debasing the currency so badly. We think that oil will continue to be a good, something you should look at. It's going to be higher for longer than people expect that it is. They want to trade it because they think it's going to come back to 30 or 40 or some crazy number, but we don't.
Markets have seen a V-shaped recovery. What's next? Are we pricing in peace? What are the best buying opportunities right now? Ted Oakley returns to the show once more. He's a founder of Oxbow Advisors. We'll find out what his market outlook is next. Welcome back to the show, Ted. Good to see you, as always.
Thank you, David. Always good to talk to you.
People should check out our interview with Ted in the past. I'll put the last one in the link in the description down below. Let me flip over to my screen, Ted, and start with this chart of the S&P 500. It looks like a dramatic rebound from the lows in late March. And there's been some whipsaw action between Iran and the U.S. in regards to negotiations. Is there a ceasefire? Is there not? Both sides have been amping up the blockade of the Strait of Hormuz. Just earlier this week, the U.S. Navy has blockaded the south portion of the Strait of Hormuz. And it looks like markets are taking this in the chin, and we're approaching new all-time highs once again. Why do you think we've had such a dramatic V-shaped recovery since just 2 weeks ago, Ted?
Well, I think people are trading off of hope, off of the news, really, as much as anything. And they think, well, this will be over really soon, and so things will, we'll be back in the money again. And I think it's a chasing of the market. So they just chased it up is what they did, David.
Would you be chasing this market right now?
No, I wouldn't chase the general market here. I mean, we buy things if they're cheap enough, but as a general market, if I were a market person, no, I would not chase that. If you look at it, and your chart shows it well. I mean, we're right back where we were basically in February, and maybe make a little minor high or something. But I would be surprised if over the next 2 quarters we don't have some more weakness back. It doesn't mean a bear market. It just means that it wouldn't surprise me to go back where we were earlier.
How was your portfolio positioned in, let's say, 2003, the beginning of the Iraq War, the second Gulf War, where if you go back further, what were people doing in the first Gulf War? And if you could jog down your memory for us, Ted, and draw parallels to today.
Well, I'll tell you exactly where we were. It was easy because we basically sold out of our last tech stock in March of '99, and we were a year early, so people were beat up on us for a year.
Yeah.
We didn't know what we were doing, but by the time we had a lot of cash. So by the time we got to March of '03, which is when the market bottomed and started up, we had bought a lot of cheap things over the last 6 months, but other things. We owned a lot of value stocks. We owned REITs, we owned things that paid real high cash flows, and all of those did really well. That was a big year for us because we had liquidity. And coming into that low in March of '03, we had probably 45% liquid. And so we were able to really own some things after a really tough 3-year bear market. And it really paid off. And that's similar to where we are today. We have, probably on average about 45% in Treasuries, but it's somewhat similar. I mean, the things you're owning today, if you think about it, the big Mag 7 are sort of like the tech stocks were, prior to that '03 low. They've underperformed really since October. They bounced back some in here, don't get me wrong, but they're chasing them again, when they probably would be better off to look at some single names or more value names, in our opinion, anyway.
Well, let's talk about oil and energy, a sector you are very familiar with. The WTI crude oil price has come back down to below $90 a barrel once again, Ted. And if you look at some of the stocks, they've kind of reflected this move. ExxonMobil, Chevron, for example, peaked 2 weeks ago. Now it's been falling down again. Would you be betting on a persistently high oil price from here, Ted?
I think what you're going to get, David, is it's going to be higher for longer than people expect that it is. If you just look at the numbers of what goes on, 20% of the oil and 20% of the natural gas of the world comes through those straits over there, plus all the things they blame. I could go down the list with you of all the things that have been blown up. So I think people are underestimating that, and they want to trade it because they think it's going to come back to 30 or 40 or some crazy number. But we don't. We think that oil will continue to be a good something you should look at. Today's a great day to buy it. As a matter of fact, they're all down 3 or 4% today, and for people that don't own it, it's worth a look at right now.
Have the U.S. oil companies done anything differently in the last 6 weeks or so since the beginning of the Iran conflict that may incentivize you to overweight them?
No, I will tell you, we stay in contact with a lot of people in the oil and gas business because obviously being in Texas, I know a lot. Our firm knows a lot of people, and it hasn't been long. See, they haven't had a chance to do anything in particular other than what they always have done. In other words, this was a quick move to $100 plus. And, you think about drilling now, the cheapest well you can drill now is going to be $8 to $10 million, even on land. But they don't move. They're not going to move that quickly after just a short period of move like that. It takes a time for them to see that that's going to stay that way before you're going to see a lot of capital come out. And I think most of the companies, they do well from the price being up, but it doesn't change the capital expenditure for them this quickly. I think you'll see that with most of these companies.
Earlier in the year, Trump had proposed U.S. companies to go into Venezuela and start drilling and extracting gas and oil there. Have you made any plays or investments based on that announcement?
No, we haven't, and I'll tell you why. Most of the big companies have already been down there twice, and they got fleeced both times. And they look at it like, well, okay, we can go down there and do what he wants, and he's out of office. If he's out of office, which he will be in 3 years, and they're right back like they were, and they boot us out again and keep all the money that we put into those fields and all that infrastructure. So they're not going to go down there. In my opinion, they're not anyway. Maybe I'm wrong, but I can't see them doing that.
Nobody talks about the cost of being right too late. Not the cost of being wrong, the cost of being right. Seeing something coming, understanding exactly why it was going to happen, and then watching it happen without you. Well, gold has gone from $3,000, then to $4,000, then to $5,000 in a very short amount of time. And a lot of people watching this right now knew that this was coming. They felt it in their gut. They understood the deficit spending, the central bank buying, the writing on the wall, but their retirement account never reflected any of it. That is the gap we need to close today. JP Morgan is projecting $6,300 gold price this year. Central banks are not pausing their gold buying, and the people who look back without regret will not be the ones who were the most informed. They will be the ones who actually did something about it. My friends and sponsors at Priority Gold created a free precious metals playbook that shows you exactly how to add physical gold or silver to your IRA or 401k tax and penalty free. They handle everything. You just have to take the first step. So call 866-407-6456. That's 866-407-6456, or take out your phone and text David, D-A-V-I-D, to 24999. You can also scan the QR code here on your screen or click the link in the description down below. Again, 866-407-6456, or text DAVID to 24999. Okay. Well, you have Oxbow Advisors published this letter recently. It's called The Gambler, dated April 2026. We titled this quarter's letter The Gambler for various reasons, which we'll discuss later. The speculative generations are in. Gambling in the form of cryptos and sports betting has taken a front row seat with Gen Z and millennials. Is that this general sentiment that you're observing with the markets right now? Is that the sentiment has been just one of gambling on political events, geopolitical outcomes? Why do you think that this particular title is suitable for this quarter's letter?
And what we said in the letter is those particular groups like Gen Z, or they call them homelanders now, but it's Gen Z, and millennials, is that they don't have a lot of money. And so they're really risking a lot to try to make something, and they're doing one-day options, they're in the betting markets, they're doing all this sort of thing, crypto. They've never learned the fine art of really how to invest. Actually, it's something you can own for 5, 10, 15, 20 years. They don't know how to do that, and unfortunately, I think they'll look up after 10 years and say, I really made a lot, I lost a lot. I'm not any better off than I was. Now, I'll get a lot of heat for saying that because a lot of these people that believe in these things are they're sold on them. You can't talk to them about it, but that's okay. It's everybody's money. You do what you want to do, but I think in the long run, they haven't learned how to invest. And what we said is, if you look at a third of all the age groups that are doing those two things, that just tells me that they're not really laying a foundation for good investing.
If you look at this chart, you've got percentage of people considering in crypto. This is pretty telling of age groups. Boomers, 8%, Gen X, 20%, Millennials, 35%. Would you be betting on the trend of the greatest wealth transfer in history? In other words, let's suppose Gen X's and to a certain extent Millennials inherit a big portion of their parents' or grandparents' wealth over the next decade. Would you be betting on what they're betting on now, what they're gambling on now, which may or may not be cryptos?
I don't think I think once they get a lot of money, they won't necessarily go that direction.
Okay.
If they do, then they're really making a mistake because now they've got a lot of net worth in hand. But I've seen a lot of this movement where we go from one generation to the next, and I'd say at least a third of them. I've seen this my whole career. They lose the money, because they didn't make it, so they don't have an appreciation for it. Whether it'll be that way with these groups, I don't know. But my guess is it won't. Historically, it's about the same all the time.
Institutional trading is still dominant amongst the stock markets, but retail investors have taken up a larger share of the total volume of trading from a few decades ago. What does this trend tell you about how markets are traded and how sentiment is reached?
Well, I think what's happened with individuals, and this goes back to when they went to decimals as opposed to quarters and halves and three-quarter spreads on the stocks. Because when you have a penny, you only have a penny spread. That means you only have to make a penny, and so with no commissions and everything, that just changed that whole game to where all of a sudden they could speculate, and speculating became more popular. But when you look at it, and I've looked at a lot of these people that do this. I mean, they'll make a lot one year, but they'll lose a lot the next year. And I don't think they're learning any of the processes of what you do to save money and make money on the long run.
Okay. I'd like to highlight this paragraph from the same letter. Do these names look familiar? One of the things going on now reminds us of the late 1990s. At Oxbow, we have a list of hundreds of dot-com stocks that went public were showed a semblance of the internet. So here's a list. Few of these names, yeah, these look familiar. I will tell you personally, I was a child in the 90s, and very few of these companies actually ring a bell, except maybe pets.com. I don't recognize anything else here on this list. Maybe you can jot our memories a little bit better. My point is, Ted, the rally that we've seen in the last 2 weeks, that has been driven up primarily by tech stocks. Oracle, for example, bounced 13% just yesterday in a single day. And I'm wondering why this particular move or this trend right now is bearing resemblance to the early 2000s or late 1990s.
Well, I think it's muscle memory. They have recency bias where whatever's worked for you well the last 2 years, you're like, I can't wait to do it again. And they do it this time, but they're forgetting that at the end of these situations, especially when these companies look at Microsoft, it's 14 or 15 times sales. These companies are expensive. A lot of these big 10 stocks are very, very expensive. And they're off, most of them are off from their highs, in October. In fact, all of them are. But they run up in this period right here because people chase what they knew, and I can't.
Yeah,
I don't think in the long run that'll work, but we'll see.
Most of these companies didn't make any money, and that's ultimately what failed. The fundamentals didn't match their valuations. Can we say the same thing about some of these AI companies today?
Well, a lot of them, they're making money, but they're also leveraging. Now, if you look at these companies now, they used to be cash machines. These big 10, top 10, They were, they had tons of cash. They had free cash flow, and they had easy. If you think about it, they didn't have to have a tremendous amount of bricks and mortar. I mean, it was easy. It was easy money, but they spent it all, and they put it all back into data centers. It's this, that, and the other, and AI. Whether it pays off or not, I don't know. But I do know this: they've changed the structure of their balance sheets from what was healthy to what I think is unhealthy.
What would you need to see to get excited about the Mag 7 stocks again?
Oh, they would have to come down. You'd have to get them in a range where you could say, hey, for the money, this could be a good buy here. I'm not against the businesses. It's just that, if you look at those, I mean, if you take Tesla as a great example, all these people beat the drum on Tesla, and you see them out there, and I'm like, gosh, have you ever looked at the numbers on this company? I mean, you wouldn't be doing that. But you have these cult followings in these stocks. Look at Nvidia and Tesla and the whole group. They can't wait to buy them. And one of these days, it'll probably be like 2000, where they sold off some. They came back in the fall, almost right back to where they were in the fall of 2000, and they murdered them the next 24 months.
Well, what if someone said to you, Ted, the reason these companies are Mag 7 is because they're able to outperform their competitors and peers, and so we should be paying a premium for these higher quality stocks. What would you say?
Well, you don't want to pay a premium, though, when you're buying a company that's messed up the balance sheet. I mean, if you're going to pay a premium, it should be prior to what they're doing now, where they didn't have a lot of debt, they produced a lot of cash, and you could see why people would buy into that. But once you all of a sudden have capital expenditures that are so high, like take Oracle, for example, that you got to go borrow money, then you've ruined the machine, in our opinion.
Now, how important is private credit? I think you've warned in a recent video newsletter, Market Update, that I think something like 40% of companies backed by private credit have negative free cash flow, and about 25% have interest coverage below 1.
Yeah.
Scary numbers. Tell us about this.
Well, I think what people don't realize is that Wall Street is always doing something to make money. And if they get in a position where they're not making money on one thing, then they'll do another. The latest two ventures of that really were private equity and private credit. Both, in my opinion, will go down as not so great, or not what people thought they were. Number one, they're very illiquid. And it's always interesting to me to see an industry like private credit that has these long-term loans with companies, and yet they tell you as an investor, yeah, but if you want out by the quarter, we'll give you your money. Now, those two don't match up. It never did match up. And so when investors requested, for example, in the first quarter, they requested $14 billion to come out of the credit funds. Yeah, and guess what? They didn't even get half of that, because they threw the gates up and they couldn't do it. But the problem is, you've got companies, and they've leveraged them up. They've gone into companies that really don't have the qualifications to be a good company. And here's what I always ask them. You tell me this is a really good company, but they're paying 11.25% on this debt when they could borrow at the bank for 6.25%, 6.75%, 6.5%, maybe 6.25%. Who's fooling who here? Who's doing this?
Yeah.
And excuse me, but that's the problem you run into with all of this.
When valuations,
it's overpriced.
When valuations are the way they are, should they be actually seeking private credit at all, or not, or just maybe issuing equity here?
Well, I don't think those companies that are in private credit, a lot of them can't do anything.
Okay.
They're hung up. What's happened is, they've invested in smaller companies in a lot of cases, and smaller companies, I mean, what's the liquidity of a piece of paper like that? It's not really good. I think that's the problem. But Wall Street will sell it to you and say, hey, you know what? We're gonna tell you what the value is this quarter on a piece of paper. We're gonna write it down for you. Now, private equity is even worse, by the way. But unfortunately, in private credit, you can't quite get away from it like that, because you can only hold the line so long, because then they'll say, well, wait a minute, in the public market, all these loans are down like 30%, or 35%. What's wrong with you? Why are you still the same? It's the same thing, but I mean, gosh, a lot of people bought into it, man. I've seen pension funds, family offices, individuals, illiquid stuff never does you a lot of good.
Well, speaking of another sector of the credit market, this is Treasuries. So U.S. two-year Treasury note, the yield's gone up 50 basis points since the beginning of March. It's come down a little bit. 10-year's gone up a little bit, but it's more or less flat. Are you concerned about bond vigilantes basically doing the job of the Fed tapering, which is to say raising up the yield when the Fed hasn't taken action yet?
Well, I'm not surprised by it because we really think that inflation will go on up all through the rest of the year, eventually go over 4% at the end of the year. But what I am surprised is some of these big governors talking about lowering rates. It's transitional and all that sort of thing. It doesn't look transitional to us. And I think the only thing I would say is if they press the rates hard, and we said this in the call, the video we did, we said, look, if the 2-year were to get to 4% or the 3-year got to like 4.25, 4.5, buy some of that paper, okay, some of it, because that probably tells you're going to go into a weaker economy eventually. And when you do, the rates are going to come down and you'll make more than the 4%. You'll make another 3 or 4. But that's the only way we would venture into that because most of our paper right now is less than 15 months.
Okay, so you wouldn't be long duration right now, given your outlook on inflation?
I don't think you can ever buy long bonds again unless you just want to trade them for 3 or 4 or 5 months. I mean, I'm pretty sure the rest of your life you don't want to own long bonds because look at this, and I put it in the call we had. We ran the debt went from 34 trillion to 39 trillion in 18 months. I mean, it was crazy. It went up 11% in 18 months, just 18 months. I'm talking about the government debt.
Yeah.
And they keep spending money. And it doesn't make a difference whether Republican or Democrat. Neither one of them care. But the main point is that means that they're going to keep debasing the currency so badly and keep printing and printing, they have to, that you just can't really afford to own. Why would you buy a 30-year bond at 4.75? Think about it. When you could buy, a 2-year bond at 3.85. I mean, there's no rhyme or reason for somebody to do that. And I think everybody that owns these bond funds and long-term bonds, and they haven't made any money in, gosh, I don't know.
Unless I'm just speculating here, Ted, but unless somebody believes that the Fed's going to be cutting rates and the 2 years is going to come down and then we have a steepening of the yield curve.
You could have that, but it wouldn't last long, David, in our opinion. It would be a short-lived thing. And that's why I'm saying, yeah, you could trade them maybe and get a trade off of it. But for us in bonds, that's not why we invest them, to trade them. Right. We own them till we get ready to use them. And I can't see that happening. And I just think if you look at the structure of the U.S. today, they're going to have to do something because we're going to be right here at 40 trillion government debt. And so don't be surprised at anything they do, though. I mean, they could come in and say, hey, like World War II, you got to buy the bonds. So if you've got a pension plan, an IRA, a bank, whatever, you have to own 15% bonds, whatever. They can do that stuff.
How does a fund like yours respond to conflict and wars? When the U.S. and Israel started bombing Iran on the evening of the 28th of February, did you think to yourself, we're going to wait for a buying opportunity, or did you immediately start selling stuff?
No, we don't sell on news. We never do that. I think that's a mistake for people. If you know what you own, if you know the companies that you own, and you know what they do, and you know where your pricing is in them, if they got a lot cheaper, we'd buy some more of them. But most of ours honestly didn't. We have a lot of minerals. In other words, a lot of gold miners, a lot of other metals as well. But a lot of energy. We owned a lot of energy too. So the portfolio is actually, they benefited in the first quarter from that because we didn't have, our exposure to tech was not very high at all. We didn't have a problem with that. But no, we wouldn't sell into something like that. David, people forget about bear market. Bear markets don't happen in a flash. I mean, a true bear market. If you see sell-offs that happen real quickly within 2 or 3 months, and then they're over and they come back. That's really not to us. That's not a bear. A bear market is where you roll over, and you just kind of drift lower and lower and lower, and it goes on for 2 or 3 years.
Okay.
That's a bear market, and
So so
that's the one that hurts people.
when the S&P 500 dropped 10% from the beginning of February to late March over the course of 4.5 or 6 weeks, what was your mode of thought here?
Well, you have about 400 companies in a that we have on the screen, and we bought some companies, during
Okay.
that period of time. Yeah, we
Sure.
put some money to work because they hit some prices that we thought were really good prices. And oddly enough, all of them but probably one are up nicely in price since that time. But it had to do with the company, and it didn't have to do necessarily. Yeah, we got the chance to buy them because they lowered the price on what we were looking at. But that's the way we look at those.
When a war like this in the Middle East breaks out, and this isn't the first war that the U.S. has been involved, as an investor, are there certain things that you turn to immediately? I mean, we talked about oil. Did you immediately turn to oil? Did you immediately turn to gold? Did you immediately turn to the dollar versus other currencies as a safe haven, for example? Did you go to bonds? Right? Was there like a war mode portfolio that you defaulted to?
Not for us, and I'll tell you why. We've been heavy in energy for really the last 2 years, and we've been heavy in gold and the other metals for probably 3 or 4 years. I mean, we've been in those areas, so we didn't have to buy those. I mean, to buy into those areas, and the only thing that we did really through much of the end of 25 and the first few weeks, we sold a lot of the first part of January, we sold some of our gold miners, sold all the silver miners. Silver doesn't looks as attractive to us as gold does here, but no, we bought them back. When they came back with that sell off, we just bought them back.
Yeah.
They went down 35%.
But did you think about, okay, let's just talk about gold. Gold on its way up to $5,500. Was there at any point you thought this is getting way too overextended?
Oh, for sure. Like the very end of 25 and the very first week of 26, we sold the gold back. We didn't get out, don't get me wrong, but we took part of the gold out. We took part of the gold miners out, and all of the silver miners. And yeah, because it was too wild. I mean, silver's up 200% last year. We thought for sure that was overdone, and gold looked the same way. And I wouldn't be surprised, honestly, if it doesn't drift back again to 4,000 or just under that. But if it does, I think it's a good buy there.
The gold miners that you said you bought back up, that turned out to be a good move. Nice rebound on the gold miners. Are you at all concerned that gold and the miners, just from a technical perspective, they look like they're repeating 2011, which is to say a double top, went down, up, and then just traded sideways and then further down for the remainder of 2012 to 2013. And of course, back then, the miners made a lot of acquisition mistakes. Are you seeing kind of the same mistakes now in the GDX?
No, I don't see that now. See, back then, they had a lot more debt, and they were selling at crazy multiples of cash flow in 2011. I'm talking about the gold miners. If the gold miners sold at the same multiple of cash flow today that they did in 11, we'd have another 200% on them from here. So, they're cheap and their margins are huge right now. It's different than it was then. I think, and even today, a lot of people don't own any gold or gold miners. I mean, they're not heavily owned for sure. And I think there's been some speculation when you ran it up to the highs, but you get that sort of thing after a big move.
Have you been more interested in defense stocks lately, or even AI companies contracted by the Pentagon, Palantir being an example, OpenAI? OpenAI is not publicly traded, but you understand the idea.
Yeah, I understand. Not particularly. I mean, we own some, obviously in that area, but it's not. But we didn't add them now. We added them during the year is where we added them, and that's where we made we were already in the stocks, I guess is what I'm saying. So it didn't have an impact to us at that time.
Okay. What's your view on cash right now? Some people are raising cash in times of uncertainty. Nobody knows how long this Iran conflict. I don't even think the White House knows. And so during times of uncertainty, their default mode is just to raise cash and wait it out. What's your view on that?
Well, I'll say this to you: we're not good enough to be out on the market 100% because I wouldn't believe it come back. We're just not. We're not that good. I hope if somebody is, then you need to you go with them, for sure. But I don't believe in that. I think if you're going to have a stock account, that you need to own stocks and you need to own the ones you like, and just make sure you have enough money so that if they get cheaper, you can add to them or add to other things. But for us, that's about 60% stocks and about 40% treasuries right now.
And I'll just end on this note. Our business is the only one in the world where when things are low priced and on sale, virtually nobody wants them. I think this is the key here of our conversation today. Anything on sale that nobody wants, but you do.
Well, I'll give you some examples. When things get cheap, I'll give you an example.
Sure.
We just bought Hershey today. Now, cocoa prices have been going down. It's a 3% dividend. Stocks well off its high. That's the sort of kind of company we like to look at. I think you can still look at some of the gold miners or some of the other critical minerals companies as well. I think people are underestimating minerals and all the critical type minerals that come out of China that we're way behind on. And so you start to look around at things like that. DHT Maritime is just a tanker company, yields about 9.5%. A little company called National Energy Services Reunited. You need to think about this. But that's a company that does all of their work in the Mideast. And the Mideast is messed up right now, so there'll be a lot of work for these companies. Same way with Schlumberger. We own Schlumberger, just bought some more of it yesterday. You got to think about their business going forward is going to be good. Just because if you're in the business of fixing things and everything gets blown up, then you're probably going to have a lot more business.
Okay, I'll end on one final question. Everyone's lost money in some way or another, investing or trading. Have you ever had a situation where you looked at a stock or a security or a commodity, whatever the case may be, and you were on the fence about buying it, and then you didn't, and then it went up a lot and you missed out on that opportunity? Has it ever happened to you? And maybe walk us through that decision-making process as to why you ended up not getting into that.
Well, let me tell you, and I don't know if anybody be honest with you, but I've had it happen a lot of times.
Okay.
Not just one time. But a lot of times when I thought, I've looked at this and I'm just sort of in the mode of looking at it, and all of a sudden in a week or two, it's 10 or 15% higher than where I wanted my entry point to be. I've gotten away from that a little bit, and that if I like a company, really, I've learned over time, if I like a company, I just go ahead and buy it and not try to think too much about it. But, I had one this year. I didn't think much about it. We owned Lyondell Chemical, and wanted a little bit of it, but I had a good dividend, but it's a lot of debt. But I thought the chemical companies would probably fall in behind the oil companies, and really I didn't buy it. And it goes up 40% here in about 3 or 4 months. But yeah, I've had it happen a lot. I never look back on it. I think people that look back with regret on what they're doing will never be good investors, because you're always going to make some mistakes. And I've done this a long time, and I've made a lot of errors, but you learn a lot from them. But there's always some of that. I don't have near as much of it now as I would have had 20 or 30 years ago, but I have it. Yeah.
Let's say you like a company and you like the management team, you like the product, they're generating good cash flow, the fundamentals look right, but you think the market's a bit expensive right now, including that particular stock. But you do like the company, and your time horizon isn't 1 or 2 months, it's many years, maybe perhaps decades. Do you ultimately care where it's trading at now? If you want to hold a company that you like for those fundamental reasons, and your time horizon is very long?
Well, for us, David, we try to hold companies, 5, 10, 15 years or more. And so if you can't quite get caught up in that, because what we found is that people that sell real quickly, like on a 15 or 20% profit, then they look up 2 or 3 years later and they left 150% on the table. And you learn that lesson when you're investing, that the way you get around that is you measure how much you put into a company. So, for example, instead of taking 5% positions in one company, we'll take 1%. Okay, so if it's a little expensive or whatever, but it's on our buy list, we're going to keep that 1%. If it gets a little cheaper, we might buy a little bit more of it. But in general, it has to do with how you size the companies you're buying, and that's how you protect your risk in a portfolio. You size it right. Most people get hurt in a portfolio because they have too much of something and they thought it was going to be great, and it's not. But when you get into big positions where you own a lot of something, then you don't have any control on the portfolio.
Great. All right. Well, before we wrap up, what's one or two things you're watching out for? Could be a data release, could be news, could be a development in the Middle East. What's on your radar?
Well, I think what we're looking out for is this, and I'm not trying to scare people or something like that. But what we look out for in this situation with Iran is this: if you can't do it, if you can't make your normal weapons work, and I'm talking about the U.S., they really haven't been as effective as they should have been probably with our big weapons, because they're using little weapons. And if something changes to where one of these countries, a lot of these countries have some very small nuclear bombs as well. They're not huge. They're not like Hiroshima. I'm talking about they're small. But if that were to enter this thing somewhere along the way, that would really bother us. That wouldn't be good for them or us or mankind. But we look at that sort of thing, and it came out a number of years ago about electromagnetic fields, where if you took an atomic bomb but you went up 300 miles in the atmosphere and you set it off up there, and what that would do is that would ruin about anything that's electricity. There's a lot of things that can go wrong here. I wonder about that, and I think that's why people need to have some liquidity, because you never know what comes out of these things. I hope it all works out fine. I really do. But when you're in these kind of times, I don't think you can bet the farm on it.
Hopefully that doesn't happen. But I'm guessing, based on the fact that your portfolio's thesis hasn't fundamentally shifted since a few months ago, Ted, that you don't think that the world has really changed permanently forever. Not yet.
No, I think the energy market may have changed. Maybe not forever, but for a long time. I think because we own a lot of fertilizer too. And if you look at the fertilizer markets, they're just been messed up. It's been good for us to own the stocks, but that's the one thing I think will be longer to change than people expect it will. I think they think, well, it'll go right back to normal. When you have that sort of interaction, though, it's going to be hard to go back to normal in a month or two.
Okay, excellent. Thank you so much, Ted. We appreciate your insights. Tell us where we can learn more about Oxbow Advisors and also follow you.
Well, the best place, David, is oxbowadvisors.com. And really, we're an open book. Everything we do is there, and we've got 11 or 12 books there. If somebody has an interest in one, we'll send you one. But all of our work is really at the website, and certainly go visit that. You'll see everything there.
I'll show the website now. Also, apparently we can fill out our information. You'll send us a free copy of Second Generation Wealth. That's one of your newest books.
Yeah,
that we can read in a flight.
Yeah, that was the latest book, which is a lot of our investors and a lot of most wealthy people.
Yeah,
really, they worry about their kids. They worry about numerous things about their kids. But we've written about that, and so maybe our insights will ring a bell with somebody.
Sounds like a fun read. Thank you so much, Ted. Thank you again, and we'll speak again soon. Take care for now.
Okay, thanks, David.
Thank you for watching. Don't forget to like and subscribe.